Hello, my name is Youssef El Barmi, and today I'm gonna present Options for the Beginner and Beyond by Dr. W. Edward Olmsted. So, first, let's start with a small presentation about the author and the book. W. Edward Olmsted has a bachelor from Rice University and a PhD from Northwestern University. He has received several prestigious awards for teaching excellence and has published extensively in engineering and applied mathematics. In the world of finance, he has more than 10 years of experience as option trader. He has been the editor of the Options Professor newsletter published by Independent Investor Inc. Okay, so now let's move to a definition of options. So options are financial instrument and it is basically a contract to buy or sell a specific financial product. Usually we call this financial product the underlying instrument, which is which it can be stock, exchange trade fund, or any other similar product. So the contract itself, and here is the difference between option and stock, the contract is very precise. It establishes a specific price called the strike price, at which the contract may be exercised. And it has also an expiration date, and when this option expires, it no longer exists and loses all its value. There are mainly two types of options, put and call options. A call options can be considered as if we uh, want to rent a certain property and left a security deposit for it. This money will be used to ensure that we could in fact rent that place, and if we never return, we lose actually that deposit. So this is how call option work. So call option, we have the right to buy that underlying instrument at the strike price on or before the expiration date. On the other hand, a put options, if we buy a put, we have the right to sell that underlying instrument on or before the expiration date. So for a put options, we can look at it as an insurance for our car. We pay the premium and then we are protected if the assets get damaged, in this case if the stock price goes down, and we gain in value, and if something goes wrong, we regain all the value of that insured asset. Okay, so let's move to basic option theory. We have a call option. We said that is in the money when the underlying price of the stock is higher than the option's exercise price, and it is out of the money when the underlying price is lower than the option's exercise price. The put option, on the other hand, is in the money when the underlying price is lower than the option's exercise price, and it is out of the money when the underlying price is higher than the option's exercise price. So an option is at the money when the underlying price is equal to the option's exercise price. In practice, the option with the exercise price nearest to the prevailing underlying price is called the at the money option. So here options give us this flexibility to to face any situation of investment. Okay, now we move to uh, Greeks or sensitivities, and those help us to describe how the price of the option changes when something has changed. It gives us a thought of option selection. So let's see the first one. Delta is one of the most basic and useful of these Greeks. It is basically the amount that the price of an option changes as compared to a $1 increase in the stock price. So computation of it is very simple. We just calculate how the change in the price could affect changing the price of the option. So when considering an option to buy, for example, we can make an estimate of the delta for that option. I say we just make the difference between the change in the price. So to estimate a new option price, we first multiply the change in the stock price by the approximate delta of the option to see how much the value of the option would increase. And then we should add that increase to the purchase price of the option while allowing for some loss of time value in the option. So here, as this table shows, it shows how delta should be for each of these positions. So when you see 3 pluses, this means that it is very positive delta. So let's move to the second one, which is theta. Theta is the next most common used sensitivity. The amount of theta is that price of an option changes as compared to the passage of a unit of time. So the value of theta is always a negative number because the value of an option diminishes over time. In the terminology of options, the loss of time value is referred to as theta decay. Now let's move to vega. Vega is the amount that the price of an option changes as compared to a unit increase in the volatility of the stock. The importance of vega is seen whenever there is such circumstances surrounding the stock become exciting for any one of reasons. For example, rumors. Rumors that the stock might be bought out will quickly inflate the prices of the options associated with that stock. Gamma is the amount that the delta changes as compared to a $1 increase in the price of the stock. Gamma is very important in situations where delta of the option becomes especially sensitive to changes in the price of the stock. Such situations we also call as gamma risk. The last one is rho, which is the amount that the price of an option changes as compared to a unit increase in the risk-free interest rate, that is the rate of a US Treasury bill. So rho should be positive for calls and negative for puts. LIBs. LIBs offer the investors an alternative to stock ownership because LIBs calls enable the investor to benefit from the stock price rises while placing less capital, because as we said, the options is just a small fraction of the stock price. So this is the beauty of options, because it gives us the possibility to gain profit but with as low risk as we can, because the invested capital in the first place is not that important. So one of the most popular uses of LIBs is a substitute of buy and hold stock. In fact, LIBs are sometimes referred to as the poor man's stocks. This is because they can be purchased for a fraction of the cost of the stock. So the main lesson to be learned from the LIBs: if the stock performs well, the LIBs call will provide a great enhanced return. On the other hand, if the stock price gains little or experiences a small drop during the first quarter of or the first half of the LIBs lifetime, the call option will perform really poorly. The option can even suffer a loss while the stock is having a small increase or small improvement in the price. So that's the bad part of the LIBs. Here is another strategy called the straddle trade. The straddle trade, the basic idea of a straddle trade is that it can make idea either if the stock goes up or goes down. Why? Because with the straddle trade we buy a call and buy a put with the same strike price at the same time. So these options should have also the same expiration month, usually about 2 to 3 months in the future. And the reason why we doing this, because if the stock price goes up, the call will show the profit, and if the stock price goes down, the put will show a profit. So here this strategy is very beautiful because it eliminates at least one part of the risk. But then, even though it's very useful as a strategy, we cannot rely on it because we don't know how much profit can offset the actual loss that we will face. The next strategy is called a bull call spread. The bull call spread strategy is when we buy a call and sell another contract. So this strategy consists on buying a call and selling a call at a higher strike. This actually lowers the risk because if we consider a bull call spread, we limit the loss to the initial premium paid in establishing the position, and we could break even when we reach the underlying, when we reach the position when the underlying is above the strike A, but the same amount as the net cost of establishing the position. Theory of maximum pain. This theory refers to where the price of the stock seems to lock in on an option strike price as the expiration nears. As demonstrated in the book, about 60% of the options are traded out, 30% of options expires worthless, and just 10% of options are exercised. So the maximum pain, there is a very controversial issue about it because the option owners feel a maximum pain, or they stand to lose the most money when the option is gonna expire. So this is a very controversial issue because people think there is a playing on numbers, and a lot of explanations have been offered to the maximum pain. Some explanations describe a conspiracy on the part of the market makers to manipulate the stock price.